right, guys. So now let's start by understanding the data we're going to be using. So this is our app, and this is what is generating our data. So here you have your statement, income statement, and balance sheet. You have your COA, that's a chart of accounts, and then we have our GL. So mainly, we want to pull our GL and our chart of accounts and use that to create our financial reports in Excel. Now, this data can be found in a spreadsheet. So app sheets are built on Google Sheets or Excel files, right? So over here, the chart of accounts is broken down into different components. So you have your class, so chart of account class, that's the high level where you have revenue, other income, cost of sales, expenses, fixed assets, the usual suspects over here. You have their account numbers, which we've given them over here. Then we have the type, whether they are debit or credit. You have the statement. So we have income statement and balance sheet. And then we have over here label. The reason why we have label, this is just mostly for AppSheet because AppSheet can't sort a column by another column. So you need to have a column that has numbers that helps it to sort it in the order you want. Yeah. But in Excel, we can actually do that. So we don't need this particular column. All right. Now moving on to the next chart of account. So from the high level of class, we come to the main. So that's where you have under revenue, you have your various revenue lines, you have your various expense lines, chart of account, under current assets, you have cash, you have bank, the likes, right? So that's the main account. So you have their account code, and then you have the class account codes. So from class of accounts, these are the account codes. So this relates to this table using this column, right? So this column is the same column over here. Okay, so that's the relationship between the two. Good. And then from the main, you have the details. Okay, so under each main, so for these main, you have these details. Okay, so this is one, two, three, and so on and so forth. You get it? So that's how the three of them are related. So we don't want to create denormalized data or normalized data, whichever it is, right? So we don't want one table that's so huge, so we're kind of broken it down, right? Good. Then we have our general ledger. So our general ledger over here has the general entries. So you have your ID. Okay, so every record is uniquely identified with this ID. Then we have the transaction ID, right? So these three entries are related. They make up one transaction. So this debit, and this credit, 10,000, 5,000, that's 15,000, and this credit, 15,000, right? And this because of this ID that we know that these three are related. Is that okay? Good. Then we have the entry date when the transaction was entered, transaction date when we indicated that this transaction occurred. Then we have the description, we have account code. Now this account code belongs to chart of account details. Is that okay? Good. Then we have our debits and credits, right? This is our things that the user enters, debit and credit. Then over here, this is a very important column. This tells us the account that's been selected, what type is it? Is it a debit account or credit account? Is that okay? Good. The reason why we need this is because it helps us create these very two important columns, which is a net debit and net credit. You get it? So even though we are doing a debit and credit, we want to see what's the net difference. Okay. So if an account is debit and you've debited, the value comes as is, right? It's the same positive number. But then, for instance, here, the account is a debit account, but it was credited. So then in the net debit, you have negative 5,000, right? So that's the difference between the net debit and the normal debit. So for the net debit, if the account is a debit, the value will sit in the debit side, whether it was it's supposed to be credited or debited. But then if it was credited, it will put it there as what's negative. What this does is it allows us to find the net of each account. Is that okay? So we just sum this column and we get the net, right? Instead of having to do all this back and forth. Okay, good. Same applies for the net credits. Now these two, that's the statement and then the run script, are two very important columns that perform an additional role. Okay. And what they do is that they allow us to write off the accounts for the income statement lines. So, at the end of every year, the profit is supposed to move from the income statement to the balance sheet, and then the account is supposed to reset, right? Now, for those who have followed this from the beginning, when I was creating the app, you already have context to this. For those who are just new to this and are just joining because of the Excel dashboard, don't worry. I have a video that explains this, and I'm going to attach it right after this. Okay, so for those of you who understand why we are doing all this, you can skip to the next video. For those of you who are new, just continue watching this and you appreciate why we needed these two columns and what they do. All right, we left off. So in the last video, we created our balance sheet, and we noticed that the issue we are currently having is that even though our income statement is looking good, and then we are passing the right debit and credit transactions, our balance sheet is still not balancing. We're able to identify that the reason why our balance sheet is not balancing, like in this case, we have our income statement over here. When I come to my menu and go to balance sheets, I notice that asset is 900,000, whilst equity is 662,000. The difference, about 200,000, is what we have as profit. Now, this is normal because as a result of the way we pass the debit and credit, or ideally, which is the right way, the profit is currently just in the income statement, but we need to find a way to move it into the balance sheet. So I'm going to try and elaborate or explain this using a spreadsheet so you understand how it's working currently, and then explain how we're going to move the profits at the end of the year, right, to the balance sheet so that it shows profit in the balance sheet while also leaving our income statement with the profit we are supposed to have. So let's go into the spreadsheet and get an understanding of this. Okay, so now we are in a spreadsheet. This is just a demo framework I have built, firstly to explain how this works. Okay, so currently we have our income statement that shows sales, we have our cost of goods sold, we have our gross profit, operating expenses, and net profit, right? Now, throughout this course, we've understood how these lines interrelate to each other to get the net profit. And then we have our balance sheet lines. Okay, we have cash, receivables, inventory, and so on and so forth, all the way to assets, and all the way to total liabilities and equities. Okay, good. Now, what I'm going to do is I'm going to pass some transactions. I've already created these transactions, right? And as I record them, I want you to see the effect they have on the balance sheet and the income statement. So the first transaction is debit cash and then credit equity. That's money has been injected into the business, 10,000. You see that. Second transaction, there's inventory purchase of 3,000. Cash reduces. Then you see inventory increases, but it's still all balance sheet lines. We have the third one where we purchase equipment, okay, for 5,000. Cash reduces further by 5,000. Equipment increases by 5,000. You can see that over here. The fourth one, right? We have inventory and then accounts payable. Okay, so inventory has, I think, increased. We've purchased inventory on credit, and then accounts payable has also increased. All these are still balance sheet items. You see, income statement hasn't changed, it's still zero, and then you realize that the balance sheet balances. Now, as soon as we have a balance sheet line, which is a sale, you have revenue of 4,000. Now, notice something, right? You see that you have 16,000 here as assets, but then you still have just 14,000 here as what? Equity. Do you get it? This is a cash sales. So the difference is your profit of 4,000. So every profit you are making is what's supposed to come over here, right? That's the difference between the two. So when I increase this 6, okay, the cost of goods sold of 2,000, that reduces this. So you see this has increased, reduced to 14,000, and this is what, 12,000. The difference is this. So when I pass all the transactions, about 19 of them, right? All you see is that what these lines generate your net profit. In this case, a net loss of 700, right? And then the difference between total assets and equity is the same 700 over here. So this 700 is basically supposed to come here at the end of the year to make this balance. Good. Now, this is simple in a spreadsheet sense. You can just do equal to that, and then you get it done. But then in the terms of an application, right, we need to actually have that flow into our equity. Is that okay? So what we're going to do is we're going to pass transactions. Okay, so I'm going to explain how we're going to do this. So we're going to pass transactions for each of these lines, okay? So at the end of the year, we're going to have something like this. So sales revenue, currently is 7,500 on the credit side because it's income. So we'll debit that and then we'll credit what we call profits, a profit and loss account. You see this of 7,500 like this. And that deals with sales. So let me copy this and paste this here. Now, costs of goods sold, okay, which is a negative, that's debit. So it's going to be credit here. I'm going to put 11,000. Sorry, it's going to be 4,300. I have to be careful. I don't complicate this. That goes to zero as well. Okay. Then we have operating expense. Now, operating expense is 3,900. Right. So operating expense, this case is debit, so I'm going to credit it. So I'm just moving everything from its original state to profit and loss account. So all these are going to happen at the end of the year. Do you get it? And this profit and loss account, what you're going to do is come here and say, okay, profit stroke loss account. We're going to do equal to sum, right? And I'm going to select all the credit, profit and loss account, items. So this, comma, profit and loss. This is debit, profit and loss. Is there another credit? So this one credit, and this debit, debit. Okay, good. So I'm going to close this. Good. And then that is going to be moved to the credit side of the retained earnings. I have to make sure I'm spelling it the right way as well. Good. And then we'll do the same thing for the debit side, equal to sum, select all the debit lines. So this, and then this. Good. And then I'll move that to the debit side of the retained earnings. Good. So at the end of the day, right, if I copy this formula and I did it right and I paste it here, voila. You see that? So it brings this 700 into the retained earnings. Why is operating expenses not flowing good? So what happens is that this is actually showing what happens in the new year. So at the very end of the year, these set of transactions are going to be passed. Do you get it? And that actually reinstates the income statement to zero. And then every new transaction we have will now add up to what we have over here. Do you get it? So if, let's say, at the beginning of the year, we start another sales, where we make sales revenue of, let's say, 2,000, and that was, let's say, cash. So what do I write cash? 1,000. You see that here becomes what 2,000, right? And this one increases by 2,000. Do you see that? Good. But then we have our issue again. That has to wait till the end of the next year for that to happen. Okay, so basically that's the idea of how this is going to work. Okay, so now that you appreciate why we need our statement column and then our run column, right? Now let's look at what it looks like. So over here, I'm going to scroll down to the bottom, right? And you can see some of the entries that were used by the script to move. And you can see some of the entries that were used by the script to move the data from P&L to the retained earnings, right? So we created a P&L account. That's what you see over here as two. And then every time it's an income statement entry, it just moves this. So I'm just going to filter one of the income statement entries. So at the top here, so this is an income statement entry. You see income statement over here. I'm just going to filter by this ID. So copy this, click here, and I'm just going to click this, and then you see this. So this is the original entry, which was a credit of 15,000, right? Income statement line. Okay, so now what happens at the end of the year? So that's why it's the transaction date, 31st December 2025, right? At the end of the year, this is reversed. So 15,000 comes here, right? To reverse it on the debit side. So this knocks this off. And then what happens is that we have a credit entry of 15,000 into retained earnings. So this too is a retained earnings account. So let's go into details. I'm going to show you this. I'll scroll down. So in this profit and loss, 7,200. In the main, we look for 7,200. 7,200. Where are you? Should be somewhere here. Good. So 7,200, as you can see over here, is retained earnings, right? So that too, that credits or is moved into the retained earnings. Do you get it? So that's the whole logic. That is why we have the run script and then we have the income statement column over there. That helps the script to know that, oh, this is an income statement line. And then I'm supposed to run these two entries to move this into profit. Now, you can do this in Power Query, right? But because in Google Sheets, we don't have Power Query, we need to use a script to get this done. Okay, now that you have a good understanding of the data structure, let's move this into Power Query so that we can do our cleaning and then we can create our data model so that we can build our report out. Okay, so let's go.